I'm super excited today because we have Dr. Barry Sachs joining us, and Dr. Sachs is such a just an advocate for reverse mortgages in financial planning. And actually, I'm not going to steal any of his thunder. Barry, if you wouldn't mind, would you mind just introducing yourself? Where did you kind of get involved in the reverse mortgage space with financial planning?
Well, I'll tell you, it goes back a number of years. Um, I have I've been a tax lawyer now for 52 years. I got out of law school in 1973. In 1974, the Pension Reform Act, also known as ERISA, passed. I was the bottom guy on the totem pole at the law firm, so they handed it to me. As it happened, I have a mathematical background. I'm a theoretical physicist by training, which is where the doctor bit comes from. And I was able to talk to actuaries through the course of my legal career, the mathematics of life expectancy, of what you do as a pension actuary, how you plan for people to live out their years on pensions and retirement savings. And I got interested in this. And as time went on, most of my work in the law firm for 30 some years was helping clients put as much money into these plans and take a tax deduction as possible. When I approached my own retirement, which, believe it or not, was 20 years ago, I got interested in the flip side of that coin, the opposite side. How do you take money out? And how do you take money out in a um, what should I say, in the most effective way, so that on the one hand, you don't run out of money while you're living in retirement and still alive and thinking about eating cat food, on the one hand. On the other hand, you don't want to take so little that you don't enjoy retirement. So there's a sweet spot, but it's not just the sweet spot. Remember that there's volatility. There's volatility in that securities portfolio. And if you take out money from that securities portfolio when it's down, they sometimes call it kicking the bear when it's down, you hasten the exhaustion of that portfolio. I said, now, what do you do to fix that, to offset that volatility? I read an article in, I guess, around 2004, five, whatever, by some economists who said, well, if you use annuities, that helps buffer or soften the volatility because annuities are steady, and that offsets the volatility of the securities. But of course, it takes money away from the securities. And you want as much money there for the growth and as little there for to take it out and exhaust the portfolio. And literally walking across the street, I remember it was Mission Street in San Francisco, the light bulb lit over my head. Wait a minute, real estate. That's a place you can get the money to offset the volatility of the securities. And I started to work on that. I needed some good computer programming to mimic the volatility of the securities program. And fortunately, I had really good luck. My brother is a professor of economics and an absolutely gifted computer programmer. So between the two of us, we worked out how to use a reverse mortgage credit line, which has the advantage of not cutting into the securities in the portfolio, but being available on a tax-free basis even. So a reverse mortgage credit line was the ideal solution. We worked it out. We published this leading article in, and my memory's a little faded now. I think it was 2012. This was the lead article in the Journal of Financial Planning. And from that, everything else has flowed. So I did
Wow.
that in 2012. In 2017, I have an actuary friend, Pete Newworth, who said, look, all other people have written stuff about this too. I was, without too much bragging, the first, but Wade Pfau wrote something about it. A couple of guys in Texas wrote stuff, and they all assumed a certain ratio of home value to portfolio value. And it turned out, including myself, an unrealistic ratio. Pete Newworth, the actuary, said, let's try some other ratios. So together we published in 2017 a whole article about different ratios and the different effects that home equity can have. And it turned out when the ratios were more realistic, the effect was even better. when you have a 2-to-1 ratio, which is actually very typical, very realistic. Many people have more home equity than they have in their retirement portfolio, and that's
Right.
realistic. And we wrote that in 2017, published that in the Journal of Financial Planning. This is getting a little long-winded, but I'll finish it up
No,
with
this is great.
an article I wrote with an actual reverse mortgage loan officer, um, a guy named Phil Walker, in 2021, and he had been in the stocks and bonds area before he got into reverse mortgages. And his idea was to take the 2012 article and the 2017 article and flip over the conceptualization. Instead of graphing success as a function of different variables, he talked about the risk of failure, the risk of running out of money, because a lot of financial planners think more in terms of risk. And it turns out that the behavioral economists also think that way. Risk of loss has a greater impact psychologically and behaviorally than the gain. In other words, if you say, which would have a greater psychological impact, losing $10,000 or getting $10,000. And it turns out losing has a much bigger impact for the same dollar amount than gaining it. So in any case, we reframed those earlier articles in the 2021 Journal of Financial Planning, December of 2021. I remember it well because it was the first one that came out without a printed edition. They in November of 2021, the journal stopped printing the monthly journal and only print a quarterly one. So we were the first ones not to be printed, but it's there in their archives. Anyway, that's a long spiel about how I got into this and what it means to me. But it turns out that after doing that, I found a whole bunch of other terrific uses for reverse mortgages, including in silver divorce, including the latest thing that we're working on, using the money aggregated over time in a brand new idea called reserve strategy for paying for long-term care. So we've got a whole bunch of stuff that, and it's the best financial tool I've ever considered. I've been a tax lawyer, as I say, for 52 years.
And you had something to do with FINRA. And would you
Oh,
mind just talking about that briefly for
sure.
everybody here?
Yeah. Okay, so here's what, this goes back now to the first article, the 2012 article. Here's what the 2012 article sort of demonstrated mathematically. Proved might be too strong a word, and shown is too weak a word. So demonstrated is the word I like. If you do the following, you get your 401k or rollover IRA, you're a retiree, and you're drawing on it, let's say every quarter or every year. I mean, we model it on a yearly basis, but of course you can do it on a quarterly basis also. And you draw money from this portfolio. But when the portfolio's down, as I said before, you really shouldn't draw on the portfolio, draw instead on the reverse mortgage credit line. And this goes from year to year. Some years your portfolio is up, you draw from it. When the portfolio is down, you don't draw from it, you draw instead from the reverse mortgage credit line. And that's called the coordinated strategy. And that's what we wrote about in the 2012 article. And the point is that if you compare that with the so-called last resort strategy, and I'll explain what that is in a minute, then you find that the last resort strategy is much worse. It turns out that the likelihood of running out of money is so much greater if you use the last resort strategy. What's that? It says, well, keep drawing on the portfolio up or down. And when it runs, if and when it runs out of money, then go get a reverse mortgage credit line and draw from that.
And that's the most common
That's the most
use.
common approach.
Right.
So, and that was the common wisdom. The Journal of Financial Planning, in its wisdom, titled our article, the 2012 article, Reversing the Conventional Wisdom, Reversing the Common Wisdom. And reversing was obviously used in two senses, using a reverse mortgage and turning it around. Well, FINRA, being unaware of all that stuff, published a newsletter of some sort in 2013, 2014, around there. It was after the article had been published, but it didn't get a lot of currency with the people at FINRA, whoever they are. And they published a thing which had a sentence in it that said a reverse mortgage should only be considered a last resort. I mean, that was the killer phrase, and it was dead wrong. And we had already published and mathematically demonstrated, I think very convincingly, that that notion was dead wrong. I called up FINRA and I said, hey, you guys, you said reverse mortgage should be considered only as a last resort. I've published something that suggests it's not. And by that time, by the way, that was February of 2012. By August of 2012, a couple of guys at a place called Texas Tech University, unbeknownst to me, and neither I knew nothing about them, they knew nothing about me. In August, they published an article which demonstrated, using a slightly different mathematics, the very same point. So when I talked to FINRA, I said, hey, some reasonably respectable academics, myself as a former academic, and the guys at Texas Tech as current academics, have published stuff that is solid mathematically and intellectually and logically, that disproves your assertion that a reverse mortgage should be the last resort. And they said, okay, send us the article. The article is plural, mine and the Texas guys. And sure enough, the next time they published that thing, that I think they called it an investor alert. It's a kind of newsletter. And sure enough, that sentence was no longer there.
Oh,
I
wow.
never found out, I found out the name of the guy to whom I had talked about sending our articles, and he asked for them. I wasn't sure whether he was the head of the organization or the janitor who just happened to pick up the phone.
Either
In
way,
all
it worked.
events, I still remember his name. His name was Pete Chambliss, and he was intellectually very open and listened. So I got to give him credit. Whether he's the head of it or the janitor, I'll never know. But in any case, they did take the advice. And subsequently, by which I mean just a couple of weeks ago, somebody from your profession, the profession of reverse mortgages and financial planning, sent me an email asking me if I had any, if I could get any material from FINRA that showed that this change had been made. And I said, all I can say is find their investor alerts from that time. And I
Mhm.
don't know if I was able to find them or not, but I did go to Chat GPT, and sure enough, up came a little thing that said that FINRA had a position against them, and then Barry Sachs came along and changed their mind. So
Yeah, we'll leave it to
that's the
AI
full
to
story.
find that information out. And we all appreciate you for taking that stance and that approach and making that happen. Because the one thing that we've experienced in this industry is we've seen just so many people have that mindset of using the reverse mortgage as a loan of last resort, using it as the last option, when really it should be utilized in the complete opposite. Let's reverse that thinking and put it up front so that you can use it as a coordinated strategy. And then
Yeah.
that brings me to really what we were talking about earlier, which is the reserve strategy that you've come up with. Do you mind just talking about that so that
Yeah,
these fine folks can understand?
sure. That's a brand new idea that was suggested by my friend and co-author Pete Newworth, the actuary. He's quite an active actuary. We first met when we were both actually I was the lawyer for the San Francisco Symphony, and he was the actuary for them. And
Oh,
we
wow.
continued to have some common clients over the years and have become friends and all that. We even he formed a little group that I'm part of called Newworth Associates Consulting. In any event, here's the story of the reserve strategy. This is everybody pretty much that does the quantitative work in planning retirement income thinks in terms of a steady flow of income, sort of mimicking a pension, even though it draws on a portfolio, a 401k or a rollover IRA. Now, a steady flow of income is fine, except every once in a while, something big hits, like the roof's got to be replaced on the house, or a family member has a medical emergency. So those are the unanticipated spikes in spending, and some that can be anticipated might be a cosmetic or aesthetic upgrade or remodel of the house. That you can sort of plan when you do that, or somebody's going to help a grandchild pay off some of his or her student debt. So these are expenses that are big spikes, and we're talking about serious spikes, double the normal income rate. So we said, everybody that's done all this mathematical planning use the simple approach, because mathematically it's much simpler to have it be steady rather than having these spikes. But anyway, it turns out that Pete and I found a really gifted programmer who modified the program we've been working with for ever since 2012 to put in some spikes. And this is a guy who just got his PhD from UC Berkeley and was looking for something to do. So one of the things we offered him to do was to build into the program we've been using these spending spikes. And he did a fabulous job of it. And the idea was, how do you manage to accommodate for the possibility? You don't know when they're going to be, but you have a pretty good sense that something's going to come along and require some big extra spending. So what we found was a strategy that we had considered long ago, but never thought worthy of much analysis. And it turns out that's the one that works best for absorbing the spikes and yet not having the retiree run out of money. And what is that reserve strategy? It uses a very weird feature of the HECM, the home equity conversion mortgage. And that is that when you start it, the earlier you start it, and the rule is you got to start it no earlier than age 62, but the sooner you start it, the sooner the amount available grows, and it grows and grows and grows. So if you keep it in reserve and only, we're sort of talking about the flip side of the last resort strategy. The last resort strategy says you use up the portfolio first and then you go get a reverse mortgage.
Yeah.
But if you go get a reverse mortgage and then use up the portfolio, you've got a much bigger pot of money available in reserve to absorb those spikes. And that works terrific. Why was that ignored before? For a very good reason. If you think about it, people don't want to incur the substantial upfront costs of a reverse mortgage if they aren't planning to use it for another 10 or 15 years, which is what the mathematics shows to be about the duration of a portfolio if you're drawing it at a reasonable rate. That is, it's a rate that would exhaust it before the retiree is out of breath, so to speak, but there's still something behind held in reserve, and that's the reverse mortgage credit line that had been building and building and building since age 62, even if the retirement itself didn't even occur until 65, 66, 67. That buildup is such a powerful financial benefit that it can be used to absorb the spending spikes that might come on. We're talking about big ones. We're talking about spikes between $50,000 and $125,000 coming twice. And we put in just two spikes. That's what the program did, and that's as much as we could deal with. And we actually had them coming in consecutive years. But we went from they're coming at 25 years, 20 years, 15 years, 10 and 5. So we've got the article. It's already been submitted to the Journal of Financial Planning. They've sent it back for some tweaks and edits, which I'm working on right now. It's going to be presented to the Conference of Consulting Actuaries in October. And it's a very interesting piece of work, and one that has not really been addressed by others in a solid, quantitative, mathematically rigorous way. So that's where we are.
That's amazing. And when we think about the planning function of this, we look at individuals that the majority of individuals are going to need access to long-term care funds. And
Mhm.
what better way than to set up a growing line of credit that you're not paying anything on and really, during your lifetime, but it's guaranteed to grow. So this is a line of credit that's guaranteed to grow. It doesn't matter what happens in the housing market, in the economy, it's not going to be closed or called due and payable as long as you keep the reverse mortgage, the HECM, in place, which really there's three main things that you have to do to keep the HECM in place. Live in the home as your primary residence, pay your property taxes and homeowners insurance, and maintain the property. Those are the three most common things, obviously, but I think it's important what you mentioned when individuals have the mindset to use the reverse mortgage as a loan of last resort. So they exhaust their portfolio and then they look to set up a HECM. That's so dangerous because now, if their only source of income is coming from their portfolio, they no longer have that to count as their income qualification factor, which we have there's minimal qualification factors to establish a HECM, but one of them is there has to be a residual income qualification that's met. And so it does make sense to actually reverse the last resort option and put the line of credit in place initially. And Barry, we've talked before about how the line of credit is really the majority of the cost to set it up is insurance cost, the mortgage insurance premium that's up front, 2% of the value of the home essentially. And that's where people just can't wrap their heads around it. I mean, if it's $1 million property, you coming from San Francisco, that there's no problem finding $1 million property. That's going to be a $20,000 mortgage insurance premium up front that's financed into the loan. Why on earth would somebody set that up? Well, just like any insurance, it's better to have it and not need it than need it and not have it. Do you
Right.
mind just talking a little bit more on that?
Yeah, as I mentioned before, if and when one uses this reserve strategy, there is a big upfront cost that attaches to the home. It's a lien against the home, and it grows over time. But again, as Jared said, think of it as insurance and not as just a sunk cost. It's a premium for insurance against cash flow exhaustion. I mean, it's hard to think about what it's like to run out of cash when you're, 75, 80 years old. But, you got to think about it. And, I understand it very well. I'm 86 and I think about that a lot.
Yeah.
And I am very happy that I have my reverse mortgage. And as I say, and this was a thought I had way back when I was still at the law firm, still having a pretty nice income from the law firm. But it occurred to me that, gee, one of these days I won't.
Yeah.
And and sure enough, I don't. So having that is a terrific sense of comfort. And um,
Absolutely.
it's something that, I really wish a lot more people would have it. And speaking of a lot more people, as Jared and I were talking before the recording began and before you folks filled the room, um, more people should be aware and
Yeah.
should have a sense that this is a good thing. Everybody has home insurance that has a home, and everybody that has a car has car insurance. And this retirement insurance should also be there as a regular part of one's financial planning. And
Really, when we look at all the different uses behind this, and there's so many, and we always like to tell people it's not necessarily for everybody. I mean, I've been in this industry for 2 decades now, and I really believe that everybody can benefit from it, but it's not necessarily designed for everyone. But at least everybody should look into it. That's my opinion. What are your thoughts on that, Barry?
oh yeah, no, I'm all for it. I mean, what I think I've read in a statistic that that appeared in our 2017 article that I think of all the retirees, that is all the people over 65, 70% own a home. That was, it's a little bit of an old statistic. I mean, it's not quite 10 years old, but close. But that's that's a notion that is worth keeping in mind. And what I also read was that I think 70% of them, that is a 49% of people in that age group, own it free and clear. So they paid off their mortgages. And that makes it much easier. But it makes it easier to get a reverse mortgage. But on the other hand, maybe it helps to have a reverse mortgage. If you haven't paid off your forward mortgage, you get a reverse mortgage to pay that off so that your
Yeah.
cash outflow is substantially reduced. Because a large part of one's cash outflow, if one has an in-place, still not fully paid off mortgage, then a lot of that cash flow is just to service that debt. And that makes it that much harder. Indeed, it makes it much more likely that the retirement savings will be exhausted. And that's the
Yeah.
big objective. Most people now that are retired, not all, but most, have a 401k like thing, a rollover IRA, 401k. Those that have real traditional pensions are relatively few and far between. They're lucky. Most of them are government, former retirees from government employment. But the old pension is really not the most prevalent form of pension for people who retire even today.
Yeah.
So it's good to think about not exhausting that pile of securities by making mortgage payments when you can avoid making mortgage payments by getting a reverse mortgage to pay it off.
Right.
Sure, a reverse mortgage is not free. It ultimately has to be paid back, but it's paid back when the retiree leaves the home, as I say,
Yeah.
horizontally or
Permanently.
vertically.
Yeah, horizontally or vertically, that's absolutely right. And there are safeguards in place when that happens as well. A lot of
Sure.
people think that they're just, signing away their home when they take out a reverse mortgage, but in reality, the majority of individuals, when that maturity event happens, there's equity left over in the property.
Absolutely.
The heirs or the homeowner, depending on the horizontal or vertical,
Yeah,
outcome, they are able to sell the home for what it's worth and then pay off the mortgage balance and keep the remaining equity as proceeds to the sale of the home, just like a regular mortgage. That's I think what we really want to educate the majority of people on is this is not some scary big bad wolf that's hiding in the closet. This is just a mortgage. It's a different type of mortgage than what most people are used to because it requires the lender to be more patient than your typical traditional conventional mortgage because payments aren't required. An individual can wait to make their payments forever. They never have to make payments on this if they don't want to. They can if they want to, which is another benefit, which we're going to get into that here in just a moment. But I think it would be good to maybe jump into the term acquisition indebtedness. And this is something that a lot of people they're not familiar with the term. They may have heard it once in their career and then they forgot about it. And you wrote an article, I believe it was April of 2016 in the
that's
Journal of
right.
Taxation, and talking about the loss deduction. Do you mind just talking about that so that we can get a better idea of how
Sure.
they can utilize the HECM for this benefit?
Yeah, I think that this is really into a somewhat different, as the saying often goes, a reverse mortgage is like a Swiss Army knife. It's got a
Yeah.
lot of different blades and it can have a lot of different uses. Um, and unfortunately for me, that article from 2016, half of it was made wrong by the 2017 tax law change, but the
Yeah,
other
the
half,
TC.
so let's talk about the half that's still good. And I am planning to actually rewrite the article. Now that the new tax law has gone through, um, I won't say my political leanings, but in any event, it's maintained a lot of the pieces from the 2017 law. So now I can rewrite this article basically knocking out half of it. It's a little bit much shorter article. But in any case, here's what the thing is, that one can only deduct interest, accrued interest, on loans that are secured by a home and used for the purpose of either buying or building or substantially remodeling the home. So for example, the use of it in the coordinated strategy doesn't make the interest deductible. So that's unfortunately part of the article takes that as an example because it was written in 2016 when the law did allow it. But anyway, let's imagine a different situation than the ones I've been talking about so far. Imagine a situation where here's one that I like to write about. We wrote about it in the Journal of the IDFA, the Institute for Divorce Financial Analysis, back in, I think this was 2017 or 18. And imagine the following scenario. You got a couple who are getting divorced, and this is often called silver divorce because their hair, like mine, is what little I have left is silver, and rather than gray. In any case, people who get divorced, either of two things happen, and this applies in both of those two things. Either one member of the couple, we're assuming the house is fully paid off. One member of the couple will buy out the other member of the couple. Now what we've got is the person who stays, the staying partner, has a reverse mortgage. They get a reverse mortgage, so there's no mortgage payments to make. And that's important because when people divorce, it's harder to live on what cash you get. Two cannot live cheaply as one except together. And when they're not together, it's more difficult. So it's better for them to be sure that if one stays in the house, he or she doesn't have to make mortgage payments. So they get a reverse mortgage and buys out the half interest of the other member of the couple. Now what we've got is somebody who has incurred a reverse mortgage, the interest accrues, but that was for acquisition. Although they didn't acquire the house anew, they acquired their interest, their other half interest in the house anew. And the person who received the money, the departing partner, will then go out and buy a new house with that money. And that money wasn't taxable because there's a special provision of the Internal Revenue Code that says purchases and sales between members of a couple, even if they're divorced, but it's incident of divorce, there's no capital gain there. That person now has some money and it's not reduced by capital gain tax. And they go buy a new house and they use a HECM for purchase for the other half of the payment. Now they have a home that they own. And I'll go into some comments about why it's, I think, crucial to own a home when you're of a certain age. And they have no mortgage payments. And they too, to the extent they got a reverse mortgage and the interest accrues, whenever they or their heirs sell the house, the interest that accrued will be deductible. So that's scenario one. Scenario two is they both sell the house, they sell the marital home. Each one takes half the proceeds and each one does what one of the partners did in that first example. They each take half the proceeds they got from the home they sold. That's the down payment. They get a reverse mortgage for the other part. They have no mortgage payments to make while they live in the house. Interest accrues, and that was acquisition indebtedness because it was used to buy the house. Okay, now that's the scenario. Now let's talk about the tax aspects. Here's the rule is that, and this is just mechanical, but estate planners should know this. I had to learn it, and I did. That nobody told me I had to go study the regulations. And I included that regulation, the citation and the language, in the very article that Jared was mentioning. That is the article that's called Recovering a Loss Deduction. Now imagine that one of these people, or both of them, die. Interest has accrued. If the estate were to sell the house, the estate would have the interest deduction, because it says whoever has the home subject to the debt gets the interest deduction. But typically, an estate of the people we're talking about are not very likely to be earning enough money, especially if they're short-lived estates, to need that deduction, to be able to benefit from the deduction. So it's lost. But if the house goes according to the will, this is an estate planning issue, the will or the trust, it goes to an heir or beneficiary or several, all the kids, then they get the house subject to the debt, and then they sell it. So who sells it is what determines who gets the deduction. And typically, the heirs of the deceased parent or parents are the ones who are typically people, who knows, they could be in their 50s, their 60s, whatever, they are typically earning income. And because they're earning income, they get to benefit from the tax deduction for the interest that they have to pay anyway. When the house is sold, first thing happens is that the entire reverse mortgage is paid back, and then what's left goes to the heirs.
Yeah.
But if the estate does the selling and then distributes the net proceeds, they don't benefit from the interest deduction. Remember, there's not much no capital gain in these things, because there's a step up in basis upon death. So
Yeah.
there's no benefit, no offset to the capital gain tax, which is small anyway. So the smart move is, don't lose the deduction by writing the will so that the estate sells the house and distributes the proceeds. Write the will so that the heirs get the house subject to the debt. They sell it. Sure, it's a little more hassle, but often the accrued interest, the deduction for that, is worth a lot of money. It's accrued interest, it's not 1 year's interest, it's the interest that is accrued over all the years that the parents lived in the house. So it's a
That can
little
be
bit
substantial.
weedy, this stuff. It depends on precise language of a regulation, of an IRS regulation.
Yeah.
But it got me an article in the Journal of Taxation.
No,
So
that's
it's
amazing.
worth something.
Absolutely. And, there are ways. So this is talking about the heirs having the benefit, which is great, because a lot of the concerns, and I've heard this for years and years and years, pretty much my whole career, that individuals are worried that they're not going to be able to leave an inheritance or legacy behind to their heirs, because now their biggest asset, their home, they're looking at it not having equity left over by the time they pass away, which is, I'll keep my opinions on that out of this conversation right now. But in any case, that makes it so that there is actually more of a benefit than just I guess inheriting the remaining equity that's left over. Now there's potential, tax benefits as
Tax
well, tax
benefits too, yeah.
savings. Yeah, so that's huge. But there's also a way that the homeowner can benefit from this strategy during their lifetime as well, correct?
Only if it's acquisition indebtedness. Yeah,
Right.
yeah, sure.
Okay.
And that gets a little tough. Again, that's dealt with in the article, and you have to be
Yeah.
careful because of the called substantial economic effect doctrine. That could be the subject of, if not a whole hour's lecture, 10 or 15 or
Right.
20 minutes. Let me see if I can do a little bit of a summary. The idea is, here's what you can't do. Let's say you accumulate, first of all, we're assuming it's acquisition indebtedness. Otherwise, the game's over. There's nothing to gain. But
Right.
assuming that one has bought the house using whatever down payment, and then gotten a reverse mortgage for the rest of it, or some or all of it. Well, some of it, because it can't be all of it. And over time, interest accrues. And then here's what you can't do. You can't go to your neighborhood loan shark, get a quickie loan for, pick a number, $100,000, pay down $100,000 of the debt, which most of which is interest, and then borrow it back from the reverse mortgage and repay the loan shark.
Yeah.
Because economically, what's happened is nothing but a tax deduction. That is, you and the loan shark are even with each other. And all that's happened is money has flowed from the loan shark to the homeowner to the reverse mortgage lender, back from the lender to the homeowner, and back to the loan shark. And all that's happened is a deduction. Well, there is a specific doctrine called the substantial economic effect doctrine that says if there is no substantial economic effect other than a tax deduction, the tax deduction is disallowed. So let me give the positive side. That's the negative. That says you can't get it. On the other hand, suppose that one does use a reverse mortgage as HECM for purchase, and then a few years later, or several years later, after some interest has accrued, along comes a grandma or Uncle Joe has died and leaves the homeowner a slug of money, a windfall. And the homeowner says, gee, that's nice. I think I'll pay down some of the reverse mortgage with this. And so he or she does. And at that point, there is a legitimate deduction and there is substantial economic effect in that the homeowner got a slug of money, got a windfall, and then paid it over to the reverse mortgage. And it stayed there, at least for what they call the decent interval. If it were immediately taken back, the deduction is disallowed. If, however, over time, economic situation has changed, for example, there's a spike expense that one needs, anything that shows a substantial change in the economics, that would allow for the payment down of the reverse mortgage. And then a later, and for economically legitimate reasons, the money is borrowed back. That is enough of an economic difference that the interest deduction will be allowed.
Dr. Sachs, here we're in the last 5 minutes. I would love to just have you share any additional thoughts or points that you want to share with our fantastic audience that we've had today.
Well, I guess the most important thing is, well, several things. I often say, don't let the tax tail wag the financial dog. So don't do things just because there might be a tax benefit if it turns out not to be financially advantageous. Also, I think the important notion for people in retirement is to think about cash flow sustainability. That's really what it's about. And cash flow sustainability often is a byproduct, a good byproduct of other things. The most notable thing, of course, is if you've got a mortgage that you're paying off, replace it with a reverse mortgage, and that saves a lot of cash outflow. There's one other thing I mentioned earlier, that when people get to a certain age, the idea of becoming a renter strikes me as not a happy idea. I've heard so many stories about people who say, you know what if I sold the house and rented? Wouldn't that free up a whole bunch of money? Well, yeah, and the but in part is you're at the mercy of a landlord, and moving at a certain age just doesn't seem appealing. For whatever it's worth, I've been in this place that I'm talking to you from for 47 years, and I love it. I don't want to move. I've got a house in the country that I've had for now, 31 years, and I love it too. And the idea of somehow accumulating a bunch of cash and then renting, but where I might be thrown out by a landlord that wants to raise the rent to an unacceptable level, or if there's rent control, the landlord might very well say, well, I need the place for my son-in-law. And that is a pretext for throwing out people. I know that there's a lot of rules that supposedly protect seniors, but too many people have found ways around it. So the idea of being in one's own place, I think, is a nice one. Now, maybe I'm a homebody, and maybe it's because I moved around too much when I was in college and graduate school. But there's something nice about feeling reasonably secure in your own place. obviously feeling financially insecure is not a good thing. And in some sense, I think the best way to have both is the judicious, responsible, intelligent, well-planned use of a reverse mortgage gets you the best of both worlds, some financial
Yeah.
security and some home-based security. Well, I was just gonna add one other thing. I have exactly, almost exactly as much equity in my reverse mortgaged house as I had before I got the reverse mortgage, because it has gone up in value at a rate fast enough to, in a sense, outstrip anything that the reverse mortgage accrual could catch up to. And
Right.
it's fortunate because obviously Northern California real estate in nicely chosen areas is a terrific asset. But a lot of other real estate in a lot of other places are also perfectly good assets and should be cherished.